All right, welcome back. Today we are diving deep into a massive fictional market crash from March 9th, 2026. Now, this might be a fictional event, but it felt incredibly real for investors. We're going to unpack exactly how a crisis that started thousands of miles away managed to hit the Indian economy, and fast.
So let's just start with this one number. Look at it, 13 lakh crore rupees. That is how much investor wealth was just erased from the Indian stock market. We're talking about a single trading session here. It's an absolutely mind-boggling amount of money, and it really sets the stage for the sheer scale of the panic we're talking about. Okay, so let's dig into the actual numbers on this Black Monday. You can see the main indices, the Nifty 50 and the Sensex, both took a serious hit, dropping over 1.7%. But, the real story, the big flashing red light, was the Nifty Bank Index. It just plummeted, down more than 4%. That tells you right away that the financial sector was ground zero for this entire sell-off.
So you're probably asking, what on earth happened? Well, this wasn't just a regular bad day in the market or some kind of simple correction. No, this was what analysts everywhere started calling a perfect storm. And it's a perfect description, really. It was this crazy, rare combination of three huge global forces that all decided to collide right over the Indian market at the exact same time.
And here they are, the anatomy of this crisis. It was a real trifecta of trouble. First, you had an oil shock. Then, the rupee crashed. And to top it all off, a massive exodus of foreign investors. So let's break each of these down one by one to really see how they poured gasoline on the fire. All right, first on the list, the oil shock. So Brent crude oil prices, which had been pretty stable, just chilling around $93, suddenly skyrocketed. We're talking a massive spike heading straight for $120 a barrel. Now, for a country like India, which imports most of its oil, a price jump like that isn't just bad news. It's like a full-blown economic earthquake. And you might be wondering, why this sudden spike? Well, here's the reason. Tensions were escalating in the Middle East, and it led to a partial blockade of the Strait of Hormuz. Now, for anyone who doesn't know, this is one of the most critical shipping choke points on the entire planet. When you suddenly threaten nearly 20% of the world's daily oil supply, well, global panic isn't just likely, it's pretty much guaranteed. Okay, factor number 2, the rupee. As all this fear started spreading across the globe, what do investors do? They run for safety. And in this case, safety meant the US dollar. So everyone piles in, and what happens to our currency? The Indian rupee just plummets, hitting an all-time low of 92.52. And a weak rupee, well, that makes all our imports, especially that now expensive oil, even more costly. You can just feel the inflation worries starting to bubble up back home. So let's put it all together. You've got a geopolitical crisis brewing, you've got the currency tanking. Is it any surprise that foreign investors just ran for the exits? In the very first week of March, they yanked over 21,000 crore rupees right out of the Indian market. When that much money leaves that quickly, it's just a massive weight, pushing the whole market down. So, with all these huge pressures, oil, the rupee, foreign money flying out, how did the market actually handle it on the ground? Well, the interesting thing is, the impact wasn't the same for everyone. This storm hit different industries in very, very different ways. It really created a clear divide between the winners and the losers of the day. And this slide just lays it all out perfectly. On one side, you had the sectors that got absolutely crushed. Think about it. Auto, aviation, banking. These are all super sensitive to things like fuel costs and what people are feeling about the economy. But on the other side, you had investors scrambling for cover. They hid in what we call defensive sectors, like IT and pharma. Why? Because they're less affected by what's happening at home, and a weak rupee can actually help their export earnings. Even a heavyweight like Reliance saw gains, as people saw it as a safe place to park their money. But to really get a feel for the vibe on the trading floor that day, you have to look at this, the India VIX. It's better known as the Fear Index, and for good reason. It shot up, jumped over 21% in a single day. A spike like that is basically a giant scream. It signals just extreme anxiety and deep uncertainty among investors about what's coming next.
Okay, now it's time to zoom out a bit, because this perfect storm that was battering the Indian market, this wasn't just our story. This was a global event. The panic wasn't staying put. It was spreading like wildfire across stock exchanges all over the world. I mean, just take a look at the damage report from around the globe. Over in Asia, Japan's Nikkei was down more than 5%, and South Korea's Kospi, wow, down a staggering 6%.
Then you hop over to Europe and it's the same story. Major markets in Germany and the UK were also deep, deep in the red. This was a completely synchronized global freefall. Now here's where things get really interesting and a little weird. There's a paradox here. Normally, in a crisis, where do investors run? They run to safe havens, right? Like gold. But on this day, both gold and silver prices actually fell. And you have to ask, why? Well, the panic was so bad that investors didn't just want safety, they needed cash. Specifically, they needed US dollars to cover the huge losses they were taking in the stock market. The dash for cash was so intense that they were forced to sell literally everything else, even their precious metals, just to get their hands on dollars. So, okay, we've seen the crash, we've dissected the causes, we've looked at the global fallout. After witnessing this incredible chain reaction, what's the big takeaway here? What does this fictional crisis from 2026 really teach us about the world we live in? I think the most crucial lesson is this. In our super-connected modern world, geopolitical conflict is not some distant headline you can just scroll past anymore. A conflict happening in a narrow strait halfway across the planet isn't just news. It's a direct economic event. It has immediate, real-world consequences for markets, for entire industries, and, yeah, for your money. And all of this leaves us with one final and maybe slightly unsettling question to think about. In a world this hyper-connected, where global supply chains and financial systems are all tangled together, is any market, or any of us for that matter, truly safe from the storm when it starts to brew? Something to chew on.